So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Elisa Zhang. Elisa is the owner and principal of a portfolio of over 450 million in holdings across 2,500 plus apartment units through her company, Easy Real Estate. After successfully building a path to financial independence for herself in less than 10 years and transitioning out of her full-time IT career in 2019, she made it her mission to help motivated other 9-to-5ers do the same by providing educational resources through her website, Easy Fi University. Elisa, welcome to the show.
Thank you so much for having me, John.
Yeah, it's great to have you. We had a nice conversation off camera, and I'm excited to get to it, but we kind of alluded to it here in your intro. You had a full-time IT career. Kind of talk about how you discovered this and your transition from that into the commercial space.
Yeah, definitely. So when we first started, I was working a 9-to-5 job. Really, it's not exactly 9-to-5, right? It's like a 9-to-6, whatever that is. So worked for a Fortune 500 company, a really large software company. And when we got into with 2009 into real estate investing, and then like everybody else, we started with that being a single family because it's a great market to buy. So kind of grew from there. And then when my daughter was born in 2015, that really changed the perspective about what is work, what is life, really all that pieces all hanging together, and the priority of things has shifted. Because it was just not okay to spend 3 hours of commute time to go to work when you can only see your daughter for 2 hours, right? The math doesn't make sense. So from there, when you have the motivation, you start working a lot harder towards the single goal that you needed. So that's when I switched mostly to multifamily. Because that's an area that has most growth. So we always started from value first, value add properties, this B and C classes, built in the 70s in Seattle. That's where I live. So we started with the fourplexes because they're residential loans, and then got into the commercial multifamily locally over here, slowly moving our property, slowly moving our investment a little bit further away from the market that we're in, creating systems, etc. And eventually, we kind of meet the market with like the market becomes too accelerated or couldn't find a deal or the way that we underwriting the deal. So we started to invest out of state. We were told you need to have 100 units in order to be scalable. So then we did invest in and got started with syndications and all that sort of stuff. So that's kind of how our journey come to where we at, and that we did do a lot of education as well. So that helped with the accelerated growth, how to get there, not making mistakes that other people has already concluded on.
Yeah. Awesome. I love that. That's a great story. So kind of talk about, in the beginning, Seattle, definitely an interesting market now. What was it like back then? Was it still as, kind of nuanced, or was it a little bit easier to find deals and kind of get them done?
Yeah. So, you mean like the Seattle market today?
Well, just relative, like what was it like back then as opposed to now?
I think it's very interesting when you're looking back, your past self, right? Like if I was looking back 5 years, 6 years ago, I would have probably be able to make more deal work if I had a knowledge that I have right now. By the time it didn't, that's why I mentioned on like, hey, deal flow wasn't as much. But if I understood and had experience what I have right now, I can probably make some deal work, right? So that's kind of relative. But I would say with the knowledge we have back then, it becomes really accelerated between 2015 running up to 2017, maybe even 2018, there's a really good run in the Seattle market and Tacoma market. So we kind of rode the market in that wave and then switched to a different market when we felt deals are not fitting our criteria and whatnot, to diversify into other markets. And then we're kind of facing the similar things right now, and then thinking about diversify into more of our Texas market, from the Phoenix market where we're majorly in. I think there's still things to be said. When is the right time to diversify? And then the scalable, like how many units do you own then? So I think it's kind of pivotal, but we see a lot of similar patterns in different locations. That market goes through the cycle of going into the high gears, and then there's a correction, and then you're in the right place, the right time. A lot of people think being in the right place, right time is a luck. There is a lot of luck involved in the past 10 years, but there's also data, like educated luck or educated the research that you do that can help you predict what's the next market and predict what's the next depression, and be able to kind of prepare for that a little bit more. Yeah.
Absolutely. And that's really what it's about, right? Taking that data-driven approach. So kind of talk about some of the data you look at, like what are your big sort of, economic and market indicators that really, tell you whether or not it's time to leave a market and get into a new market and things like that?
So I think there's a pivot. There's multiple ways that you can pivot. You can pivot and diversify between different markets, and you can pivot between different business strategies, right? So it's a combination of all that. So a few market indications that we look for is very standard, just population growth. And a big metric people kind of often miss is that basically inventory that's coming up, that's new build that's coming up down the pipeline. What is it? Because I think Kenny McRae says this, like you always want to skip to where the puck is gonna be, and you're not trying to skate to where the puck is right now, because it moves, right? So if you do that, then you're like behind the curve on everything. So market data analysis, when we look at it, is not only currently what's the population growth, job growth, because that has a little bit predictabilities in the future, but also how many inventory is coming down from the pipeline, in terms of like absorption rate. So how many absorption rate is just simply if you're no longer building any new buildings on like all the current market, how many months does it take to basically burn off all the inventory that's coming up in the next cycle. So when you look at it, so for example, like Austin is a great market, but I'm always a little bit sheepish on Austin because the absorption rate is pretty high, the over 24 months period. So, the standard over there is about, anywhere between 12 months to 24 months is like normal cycle. We're like 18, 24 is okay. Beyond 24, you're kind of in what we call the hyper supply stage. And then under 12, you're in the like a basically super undersupplied scenario. So it's the growth and the inventory, supply and demand. The combination of that causes your rent prices to potentially increase a lot more. So for example, Austin, I think Austin is a great market to invest in, but I'm often scratching my hair to like try to make sense of it, right? So there's obviously a huge job that's coming, 5-year plan, because these large company, when they move headquarters and etc., it's multiple years of planning. So that job is coming, like there's stuff here, but as currently it's in a hyper supply stage, more than 24 months absorption rate. So you're like, okay, can I push the rent during this period of time? Like, what is that leg going to be? We're using Phoenix as a market. We're very familiar with it because we're invested in there. Phoenix was at 13 months of absorption rate. So that's on the super low spectrum of that. That's why people were like in Texas, they're like, it makes no sense. Why are you buying properties? Like now properties are trading almost over 300K a door for B and C classes building. It's way higher than buying a new build in Austin for 250K a door, right? So you're like, it makes no sense. Why would you do that? Well, but the rent increases has been also astronomical, has been going through year to year increase of 27.3%. part of it is because it was harder to build, the permits process take a long time, so arbitrarily caused that shortage of supply. And then if you have people just moving into there and you have shortage of supply and there's nothing in the pipeline, then that is what's causing that rent increases over there. So that's just kind of some examples over that. You know, an opposite example would be, you know, San Antonio in the past like 2 or 3 years. It's been a little bit tougher market and people still make a good returns in there. But it's a little bit tougher market to kind of operate on because, you know, they were having hyper supplies. Also, the rents are not like the population growth, inbound population growth is not as astronomical like Austin or Phoenix as well. So it's a combination of all that. And Houston traditionally has been a little bit a harder market to break into or deal very quickly because, you know, it's unzoned in Houston. So you can build, you can tear down a single family home and decide that you're going to build 40 units over there, unzoned, right? Like it's crazy. So there, like all of a sudden you just replace the one with 40 new inventory. It's a lot easier to build. Then your supply is higher. So as a result, your rent increase is not as astronomical. So these are things that I look as the indicators and when we go into a new market. Yeah.
Awesome. I love that. That's an incredible detailed explanation and really not something that you hear a lot of people talking about is that absorption rate and different things like that, that really are kind of those back end indicators that really are showing what's actually happening. And like you said, from an operational standpoint, are we going to be able to increase rents and continue to push them up? So as that kind of happens, you also kind of alluded to different business plans. So kind of talk about some of the different business plans you guys have done over the years and, what you really like and kind of your bread and butter and some things, you've kind of stretched on as well.
Yeah, so we always stick with our value add B and C classes. People will say, well, why don't you diversify into some class A's or this and that? Well, the fundamentals, I'm like, yeah, diversification is really important. I think Warren Buffett said this, not exact quote, but he kind of talked about like diversification is for people who doesn't know what they're doing.
Yep.
Right. So for passive investors, you absolutely need to diversify because you don't have the expertise oftentimes, just passive, because as syndicators, we passive invest too, but that's a different bucket. So you got to diversify between projects, between different locations, between different asset classes, right? Because you're not the expertise running these syndications. But for people who are operating, you have a niche and you're it's kind of like this analogy of Michael Jordan goes play for golf. Like he is a awesome player at NBA because that's his bread and butter. He knows it so well. But one point of his career, he had decided he wants to play baseball, right? Or golf. Can't remember which sports it is. Yeah, baseball. And then he was okay, but it wasn't like he's a superstar in baseball, right? Like, right. So that's an analogy over here is like, you got an expertise in a particular area that takes years to hone, and all of a sudden you wanted to get into a different market, even different market or different asset type, and it takes time for you to train up to the same superstar status as you had before. So when we have deal flow, there's no need to look for other asset. Like if there's enough deal flow to even having enough equity to buy them, then you're in a good sweet spot. You should just like continue refining your craft. It's market shifted like now, which is a very interesting time with interest rate increase that cascade impact to the commercial world is quite big because I've talked with my lender sometimes. Every week we have a sync and he'll be like, oh no, like the market just went up 50 base points and then now like some people are pulling out their financials, or hey, 3 months ago it was really hot for pref equity and the pref equity is nowhere to be found anymore. So the capital market changes due to interest rate changes creates a lot of very interest dynamic over there. And also when you have hot market like Phoenix, hot market like we were just talking about Utah, like the pricing doesn't make sense with cash flow to some point. Then you start thinking about, okay, if my current business isn't working, what are other strategy I'm going to shifting to, right? To adapt to it. And also if the interest rate continue to increase, last 18 months, the type of the loans that we work on made sense. last 18 months, but this 18 months I have to change my loan structure, leverage structure, in order to make sure that we're mitigated down cycle. So these are kind of interesting things to look at, but traditionally we've been kind of always doing class B and C bread and butter. I always like to focus on things that are need based, not want based. So class A is the example of want basis. There's luxury apartments you can rent for $2,700, even $3,000 now in Phoenix per unit, like a 2-bed, 2-bath, right? So, but in Seattle, you think that's high, but in Seattle, like studios are renting for 2,500, 3,000, right? Like San Francisco, even higher, but that's a supply demand thing. Versus at the BNC affordable, workforce housing is what we call. You need that. Families need to have 2-bed, 2-bathroom houses to have 1 child or 2 child that may be somewhat close to school. They may not even be great school, they're just convenient school to be in. These type of housings are need houses, because even if the market crashed, the people say, oh, I'm not going to live in the class A luxury gym anymore. I don't need that stuff, but I still need a place to live. So then what is the lowest cost here? Where can I save money? And these type of assets still essential services, essentially. So I like to kind of focus on still the B and C is where our niche are. And then due to the market cycle where we are right now, we didn't want to take on a huge dependencies on build new construction. As we kind of see that 2 years ago, we've kind of shifted our criteria to say, okay, we're kind of getting into this preservation of wealth mode versus continued growth. We still do that, but the asset we buy has to perform well also in a down cycle market. As IA, we can hold on to them, not like performing per projected, because in the down cycle market, forget it, right? Like there's a lot of variations to it, but it's like, can we hold on to the property? What are the strategy we need to do to hold on to the property? So you have to kind of pivot that with the market. So we buy things that doesn't need a huge lift, right? But we look at operation, and that's our strong suit. So we're good operators, delinquencies, management, like, raising rents in the accelerator market like Phoenix. These are all like our strong suit. So we buy property like that, and then we focus on reducing of expenses by reducing utilities or negotiation of PM fees to increase the cash flow position, all that sort of stuff. That just kind of really straightforward, no frill strategy. And then we look at, okay, now we're going to be talking about renovate some of the unit. We budget in all the money that needed to renovate, but our stance is always on renovate as few as possible, but increasing our renewals and all that sort of stuff. So as a result, we bought our larger properties. We buy B location or better, because during COVID, some of our early acquired asset that is in the C- location, higher crimes and etc., they didn't yield as well in the scenario when the market is going downsize, right? So we start to shift it toward more the B location properties. Asset type wise, there's B and C. We buy them, but then the interior unit oftentimes has a percentage already updated. And then it really depends on the market, because it's kind of crazy in Phoenix, when back then when a completely updated property would actually trade it at a more wider cap rate versus the property that's completely classic. Because we got a lot of new operator come into the market, and there's a hype on classic unit because they think intrinsically there's values that they can add it. So oftentimes we go on the bidding, a completely classic property trade at much more compressed cap rate, and then you looked at it, you're like, okay, it doesn't make sense. Like I have this property that's mostly updated already, but operation wise they're not that great. And then you can have a much shorter window to improve the operation, because you don't need to actually wait for construction to finish before you can charge people more rent. It's already finished, right? So we kind of look at that. That's our way to kind of mitigate the risk, and then it seems to be the strategy is paying off on these units. Because now all of a sudden with the war, with the inflation, material costs have increased a lot more. So margin area is a lot more, like more than 20% of cost difference in the margin. And then because our business wasn't hinged on huge amount of construction, we're not seeing that much of a swing over there, right?
Awesome. I love that. That's incredible. Really laid that out. And you kind of touched on something that I haven't heard a lot of, but is obviously starting to come to light is delinquencies. So kind of talk about how you are finding these places that are having a lot of delinquencies and it's obviously becoming more prevalent.
Yeah, so one reason why we invest in Phoenix market's been great is also the accumulated experience we had investing in Tacoma. So people, maybe not everybody know, like Tacoma has gone through a growth period in 2016, 2017 that really similar to the double digit growth that Phoenix is seeing. Phoenix is even more accelerated to that. Nobody expected the market to be huge. But in the environment where you have 20%, 27% of rent growth, like Phoenix did in the last 2 years per year, which is really crazy, you're kind of seeing there's two big value adds over there that's not physically you can see. One is the delinquency caused by COVID, because when COVID hit, people said, hey, we can live for free. So a lot of people has just relapsed on their whole rent. And the operators are not particularly strong on pushing that, or they're doing constructions, right? Renovating a unit, they need to keep it occupied. This is a big value piece over here that they just did not touch on, because you have to keep the heads in there in order to transact. And then in Phoenix, because the rent growth is so big, you got these builders that comes in and renovate all units and would take it all the way down and do a lease up. But if you're doing a lease up during COVID, you have to give out a lot of concession to do that. So the second piece is that loss to lease. So if you're thinking about, typically leases are 12 months. And if you haven't raised your rent for a whole year in Phoenix, you're effectively more than 25% below the market, because that's just how much the market rent has increased.
Crazy.
Right. So it's not that oftentimes it's not that you're terrible as an operator. It's just simply you can't get these people out of the lease. So these two pieces are our biggest value add when we're looking at the Phoenix market. Also, there's a unique piece over here. Fewer operator actually does it, and I think we're a little bit ahead of everybody there. Is we're actually looking at like, how do we reduce expenses? So for all property we take over, we're very energy conscious, green conscious with that. So we always do a water saving pack. That's a normal thing. All syndicator knows how to do it. But we also look at taking these Phoenix buildings and actually put solar panels on top of them. So we found that this niche of buying all bills paid building, which is master meter building, most time people don't like them, but we like to buy these. So then we can put solar panel on top of it and then offset 40 to 60% electricity cost. So that's bottom line improvement. And then a dollar saved worth a lot more than a dollar earned, right? So a lot of people focus on income. How do I raise the rent? But during time of hard, you're thinking about how do I actually saving money too. So that there's ROIs to that as well. So these are some stuff that we look at, and then we like to do these program and also adding Wi-Fi's and etc. Just adding amenity, again, that need essential service spaces. Focus on, if I was a tenant and I'm pretty frugal as a person, and the luxury stuff, it definitely have to be like at a high bar for me to be like, okay, I'm gonna pay $100 extra every month in order to pay for the luxury. It has to be a need luxury for me. So when I'm putting that goggle on, it's like, okay, what are the amenity that is need based? So Wi-Fi is, right? Wi-Fi is, if we provided that service to our tenants, then we get more on the rents. It's more justified rent increases. There's other things, so like if I saved you electricity, like then you can pay more, a little bit more on the rent, because the overall cost to you is all the same. So it's creating these win-win values for the tenants alike. Is, I feel like it's a great strategy to make sure that you stay in the affordable, like, I don't want to use affordable space, but you stay in the workforce housing, the need-based housing. Yeah,
Absolutely. Yeah. You don't want to price your own residents out of the asset or out of their apartment. So you kind of touched on something that not a lot of people talk about, which is reducing expenses, right? And everybody always talks about adding value and increasing rent, but not as many operators. And I'm sure, you didn't just discover something that nobody knows about, but they don't talk a lot about that reduction and how important that can be. Like you said, a dollar saved is more than a dollar earned. So,
Yeah.
As you're kind of building this, business style and this thesis, obviously bring on investors and different things like that. So kind of talk about your approach to investors. You guys have kind of your bread and butter, but you may venture outside of it here and there. So kind of talk about, what it's like building that investor base and keeping them, so, hey, we're going to do something different here, or this is a little bit different opportunity, and keeping them repeat investors.
Yeah. So we're pretty good at keeping our repeat investors. Most all our offers referral based only. And then we don't do great advertisement everywhere else, because most of our offer is 506B. We only accept the people who we have a substantial relationship with. So that being said, the way that we kind of do that too is we always constantly innovating in terms of like market pivots. You can't be just offering the same thing, rinse and repeat. And then it pivots quite rapidly, but not so rapid. It takes about a year lag time, 6 months to a year lag time. Like you see it coming. Real estate investing is cool, unlike stock where you can have a overnight crash or overnight surge. Like it's still a pretty steady thing. Like you see the train crash, if there's a train crash happening, you see it coming from a mile away, right? So it's oftentimes you either suppressed your intuitions because you got caught up by greed or whatever, and then you like just say no, it's not happening. It's like it's happening. Like you got time to kind of mitigate the things. And then on the other hand, also we listen to our investors. So oftentimes all the changes, the pivots of deal structures, etc., over the years, it has evolved. And it has to do with the markets as well as what investor asked us, right? So we constantly learning new things. Just an example, we start introducing a couple years ago this pref equity idea, but it's really a common equity. So traditionally, we have only offered a straight 70-30 split between investor and us, right? So everything kind of split down the middle. And then in the past, some investor says, well, someone else is doing pref means that the investor gets paid first, made whole first up to that percentage, and then the general partner gets paid. It's like, well, that's how we would operate it anyway. So, okay, let's add a pref in there because it is aligning with our investor first, concept that we always push internally. So we added a pref in there. People feel it's good with it, right? Because they know that really we're driving to earn the profit. In order to earn profit ourselves, the investor has made whole first. And then people were like, well, we have two buckets of investors. Some wants cash flow and some wants equity growth because they have a steady W-2 job for the next 5 foreseeable years. And then having cash flow is really kind of waste of money because what are they going to do with the cash flow? It's not a lot of recycle that you can do with the 7 or 8% of cash flow every year, right? Whereas we have other investors who are retired. So they're like, we're counting on that cash flow and we wish that's more. So we split the classes up and then did some deal restructure. So we were able to offer our cash flow investor the cash flow down to 10%, 11%, but no upside on equity. And then we put the equity investor more on the equity side and then lower in terms of our pref because they're more invested into equity and then want to build their wealth in a longer period of time. So this way, everybody kind of gets what they wanted. And then the people who still like the straight split, then they can blend the two classes and make the investment that way. So you kind of create a little bit more diversity there. And also last year, we start noticing this constant question that we had in our head is, we have investor reach out to the like, okay, we invested 300 to 500K. Now what? Because if you think about it, if you're earning a 7 or 8% rate out of 500K, even 11%, let's say, as a cash flow investors, on a cash flow basis, let's say you invested 500K, you only get like 50K back per year. For some people, they can retire with that investment, but for some people, it's not enough. Averagely, I think most of investors will live comfortably at 100, 150K per year. So like the question is like, how do you passive invest your way to retirement, right? So we thought about it and we looked at our track record, because I also own some property myself, just private holdings and whatnot. We had this pot of gold we talked about in like 4.5 years, we have 7x'd that pot of gold through multiple 1031 exchanges, right? We're super poor on cash flow on these deals, but in terms of creating wealth and growth, that's a huge amount of acceleration. That means you're pretty much doubling every single year, right? On that. So then this concept of wouldn't it be awesome if investor has made theoretically one investment with us, and then in 12, 15 years or 10 years, we can tell them we have 10x'd it. Now we have other plans for you, and then now you can retire, right? So this concept is like really, so been kind of thinking about it. And then so there's a aha moment that showed up where we looked at these smaller projects we did. These are the stuff that we just had ownerships over. And then these projects takes a lot less time to turn. So we're able to do kind of more rapid iteration versus the 5-7 year hold as our large properties are. It's higher risk investment though, because it's less cash flow. So the focus was to try to create a wealth accelerators. And the concept of investor life cycle is like, okay, like I have a job right now. A lot of our investors will have a job right now. We don't expect to retire in 5 years or maybe even 10 years. So you don't need a cash flow during this time. So what happens if we create a wealth accelerator using the tax efficient way of 1031 exchange, et cetera, and then create 10x factor to your pot. And then in the future, we put it on a 5% yield. So how do we actually do this? Would it be like, if you use some numbers, if you invest a 300K, right, as investors, theoretically to a single investment. And then in the future, when we're doing 1031 exchanges, snowballing the whole thing, if we're only targeting 40% growth every 2 years or so, we can exit, right? So that's about 20%, 90% IRR. It just turns out in 12 and 15 years, you could have 10x yourself conservatively. And so when you do that, then 300K turn into 3 million and you put it into a 5% yield. What do you get that? Like a new build class A, something that's more stabilized, just cash flow yield, less maintenance, predictable. Now you're getting into the preservation of wealth because you want to keep your principal and then receive the cash flow. It kind of aligns with the investor life cycle. So then truly you can be like a one and done, right? In reality, we don't suggest people to invest 300K into one single deal. We'll say, okay, diversify between 3 or 4 deals. That's like this type of bucket. And then as you kind of pitch it in, you see it go full cycle coming in. And because if we're only targeting 40% total return instead of 80 to 100% total return, like a larger projects are, you're playing with the time. So, a 70 unit property, less than 100 unit is what our targets are. And then oftentimes they're in between 40 units to 70 unit. They're like kind of no man's land. So we're taking our operation from these larger operation, the efficiencies that we have created, and we're grouping all these smaller projects together. So they actually are the 150 units together, but it's 3 deals, it's 3 different like offerings. So we can run these projects pretty quickly, because if you think about it, 50 units, you have 10% that you need to do an upgrade on. You only need to upgrade 5 units. Hopefully in a year you can get it done, right? Like hopefully,
Right.
Otherwise you shouldn't be doing anything. So then you can kind of turn the time. It's about this concept of controlling time instead of return. So target a first base hit, like a 40% return instead of 100% return, which is you try to do a home run in one single investment, but doing the rapid iteration. So, in 5 years, you can probably do 2 or 3 rapid iterations and using the efficiency of 1031 exchange, save the 15%, 20% tax that you defer it essentially, and then increase your purchase power. So this is kind of how you get the whole snowball rolling.
Wow, that's incredible. And is that set up like a fund then? Is that more like a fund style over
Yeah,
there?
not currently. We did some testing on this. It's been very exhausting in our back pipeline, because smaller deal, you got like to do a lot more of this, right? So we have started to group some investment together as portfolios. So this way investor can invest in one investment, diversify 3 projects and then for efficiency of operation too, you're not out raising for 3 deals, you're out raising for 1 deal. Or so we kind of thinking about, okay, maybe we can now start grouping them every quarter. We'll make a 1 offering, and it's a slew of portfolio that you put together. Next step would be like moving that into a fund, because I think there's still some uncomfortable, because we always do per deal, right? So people are used to this. So to throw your investor all of a sudden to a blind pool fund, it's very uncomfortable. So it's a slow way to pivot our investor, introducing them the concept, and then just to see how it runs before you invest all these resources in creating funds and etc. So you asked, like, how do we pivot the investor strategy? So these are all things that we have done to really correct courses, lower the risk, doing like a risk mitigations to our portfolio, but also setting people up to more longer term passive investment. It's like set and forget it. I think most of passive investors are looking to set and forget it because they view us as the experts. So it's like, how do you actually make that even more lazy investment is what we're kind of constantly thinking about. Yeah.
Wow, that's incredible. So that's awesome. So I was going to ask, how do you kind of keep your network maintained when you don't have a deal? But it sounds like you guys have a constant deal flow because have all these different strategies based on kind of different pools of investors. So investor relations is obviously like a big part, right? That discovery call, especially since you're doing 506Bs mostly, and really understanding the person on the other end of the phone and what they want, and then being able to kind of, this is we do this is better for you, or we do this is better for you.
Yeah, absolutely. Because we know our investor very well. A lot of our friends and family when we first started, and like I mentioned, everything is referral based. So that's kind of a nod. Like our marketing is getting up there, but everything is referral based. So we get really excited when our investors have gone couple full cycle with us and they said, oh, I have 5 more people that I can introduce you to. So that's how we grow our network, because it's really a results based referral network in order to kind of get your reputation out there and earning the trust for your investor. And I think it is a huge key to have that relationship with your investor. Even when we grow bigger and bigger, we still like to kind of stay in the spirit of 506B as much as possible, even if in the future when we're doing 506Cs, public advertisement, we still would like to make that more exclusive, because here's a couple things. Like a lot of us entrepreneurs, when we do our business, it's a freedom of choice that we're trying to chase for. So to me, a check is a check, is whatever it is. But we would like to have that freedom of choice, to freedom of doing business, to say no to folks who doesn't fit our criteria as investors. So it's a very much a two-way qualification that we're seeking. It's that two-way qualifying process that we're seeing, because I think we want to make sure that the investors that we helped with growing wealth are our type of people who really take relationships at first priority, taking respect for each other, each other, and also giving value first. So that's like all things that we have said is our core values for our employees, but also partners, but also investors, right? So like we would say no to investor what we feel that's going to be mistreat our staff in the future. I think that's really huge, because why? That means they're not focusing on bringing value for other investors in the pot. So we want to make sure that we have a true partnerships with our investor, and it's a long-term relationship that we're building, right?
Gosh, I love that. That's so incredible, right? And obviously you guys have the track record now where you can turn down investors and be like, no, you don't fit, our criteria, as opposed to, in the beginning, you're kind of taking whatever you can get. But it's really awesome. You guys have gotten to that point. And obviously, it's mostly friends and family and referrals, which really kind of mitigates that. If you're getting a referral from a friend or family, most likely they're already going to kind of fit that criteria anyway.
Right. Yeah, because It's not always though, because there's maybe a few folks that still need to deal with too. But in general, like I think the similar attracts. So if you put this out to the universe, and I actually walk through my investors on what our core values are, oftentimes on the phone, so that I can kind of see if they mimic that, if it resonates with them. Right. So like if all the same, we want to help people who want to help. The other part of the things that we really wanted to do, the reason why we wanted to be in this business is provide housing, and providing housing as a bridge for people, tenants that can have a more positive impact in their life. So, financial education is something that we're really passionate about. So we wanted to make sure that in our community, we start connecting the community resources there are, which there's a lot, but people are not aware of them. Oftentimes they're so busy with their day-to-day job growing at our tenant level, because they're all workforce housings, right? Like, so most people are not proactively thinking about these things. So how do you actually bring some financial literacy to that? So our thoughts is creating nonprofits, and then actually, we have this little ecosystem going, so we can host community event once a month or once 2 months, and then connecting the community resources with the tenant. It's a very simple thing to do, but that made them aware of there's a other side of the coin, or there's a ways to better their own life, and it's up to them to take that opportunity or not. So that's a vision that we have, and the reason why we want to own more and more units is to make that bigger impact, to people. And I think when the Maslow triangle, when it talked about the hierarchies, so like first you're trying to make sure you have food and shelter, you're satisfied, and then it kind of works up, to a point where then you're kind of looking to, have being fiscally okay, taken care of. And then you're going to reach to a point where you're asking for freedom, like the financial freedom, or really is enable a freedom of choice for you. So you have your independently, your own freedom choice. And I think the last stage is about, once you reach there, then it's about, what other impacts you can make to other people. So like personally, I'm at that stage where it's like, you're like, okay, our families are taken care of, employees are taken care of. We have the freedom of saying no to people who don't want to say anything yes to, or we have the freedom to help people to kind of make it better, impact others to up level themselves. Then like, what other impacts can you make in society? So that's kind of the things, kind of constantly running through my mind. Yeah.
I so love that. That's so awesome. Going all the way back to giving back to your residents, and at that level, obviously, being philanthropic outside of that as well, but that's so incredible. And I can only imagine, how the tenants feel when, the owner is going all the way and creating these opportunities for them. So that's awesome. So
Yeah. And it creates a win-win situation, right? Because again, it's like, if you provide a value to people, you're going to get that received back. So using one example is, one of our, property in Houston, is currently providing lunch, for the kids at the property, all of them for free. So they just, apply, they will say, hey, our kids need a lunch, then they get a free lunch for that. And then that's where it's not coming from the investors, and then that's making that connection with a local charity group, and the local charity group is providing that resource of meals and etc. It may be a single factor of like, hey, you're providing lunch, but imagine the burden that you have lifted, the, woman that is like having to be responsible for it, right? That's just one extra thing they have to do. If they have like 3 kids, there's like 3 extra lunch that you have to pack. But now you don't have to think about it. It's like, oh, I'm just gonna go to the front office, pick up my lunch for my kids, and we're good to go. And then if that was one of your amenities or the perks that living at our community versus right across the street, they're not doing that. Then you're like, why you provide lunch for my kids? Like for this, like, dude, that's a really good retention, right? So it
incredible
goes
retention.
beyond that, and I think it creates a win-win situation for the investors as well as the community.
Awesome. I love that so much. That's incredible. Wow. I haven't heard of that, but I love that. So unfortunately, we are, up against time here. So I do have 5 questions that I ask all of my
Yep.
guests. It's the final 5 questions. The first one is the best advice you've gotten from a mentor.
I think it's just getting a mentor is probably the best advice ever. And I would say it's not advice from my mentor, but I would say pay for your education. The ticket size, the expensive education or network that you join, it's an eliminator for the noises potentially that's in there. So I would say pay for your education is the biggest thing.
Absolutely. And obviously there is a price tag involved, but really focus on the value of what you're getting, and the price won't matter at all.
Mhm.
What is it about your career that makes you feel like you're fulfilling your why?
I think, I was just kind of shared it before. I was really passionate about financial education for people, how to influence that. So I think that really here we have a full circle vehicle that allows us to impact people with financial freedom from the investor side, as well as financial education for the tenant, the masses there. Yeah.
I love that. That's awesome. What's your favorite non-real estate or investment related book?
Who Not How, and then the gap it was it the gap
The
and
Gap and the
gain?
Gain.
Yeah, so huge fan of Dan Sullivan. I was part of a strategic coaching as well. So these two books are definitely huge. Last year we have 2 full-time employees. This year we're at 15. And
Oh,
that huge
wow.
growth is coming from the concept of a who, not how. You start thinking about that whole thing that they talk about in the books. It unblocks you in many different ways. Yeah.
Yeah, it's incredible. One of my favorite books as well. If you could have any superpower, what would it be?
I guess travel through time. I don't know.
I love that.
So then I get more time. I think as an entrepreneur, we always constantly struggle with time, right? So
Absolutely.
got double the
Absolutely.
time.
But Who
or
Not How
maybe being
teaches you how
Flash.
to multiply time and create more time. So
Right,
I
right.
love it. Awesome. And last question, what's the best way for people to get a hold of you and learn more?
Yeah, so check out our website at the Easy FI University. So that's Easy FI spelled out university.com. We have tons of articles and blogs that we publish every single week on the details. If you like what I share over here, more the detailed analysis of the example, market updates, macroeconomics, as well as the basic of investing. Like we share different types of articles over there every single week. So you can find us there, and then also find us on YouTube. Just search my name, Elisa Zhang, and we're gonna have a lot of material that's coming up. Yeah.
Awesome. I love it. And we will link that in the show notes. Elisa, thank you so much. This has been incredible.
Thank you so much, John, for your time.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.